So first of all, thanks very much for tuning in, and thanks to the EasyEquities guys for hosting us today. I've got Waylon alongside me from EasyEquities. He's going to help me if there are any technical questions around the platform, or if you want to ask him any specific questions. We're going to be chatting about tax-free savings accounts today. So we're really pleased to be presenting to you. My name's Chris Rule and I represent the Coreshares business. Coreshares is a passive asset management business. We have 10 ETFs trading on the JSE, and we also have unit trusts, and we manage portfolios for larger clients as well. So thanks very much for tuning in. We're going to try and get this webinar done in 20 minutes. We're very cognizant of the fact that you've taken time out of work. So if you have any questions, it's usually best to deal with them after I've gone through the presentation. So feel free to, I can see there are already some questions coming through. Feel free to drop them in. Just as a general disclaimer, we're not offering financial advice or tax advice. We're going to present you the facts, and we're going to try and help as much as possible without straying into the advice world. So please just be aware of that if we can't answer your question exactly how you would like. So let's chat about tax-free savings plans. Tax-free savings plans was an initiative from National Treasury which was implemented on 1 March 2015. Effectively, it's an opportunity for individuals to save up to 30,000 Rand a year and up to a maximum of 500,000 Rand in a lifetime, and they can save tax-free, which is really a great opportunity for savers. And what that means is you get all your dividends are tax-free. There's usually dividends withholding tax of 15% on dividends. It means your interest is tax-free. There's usually you would be taxed, excluding the exemptions, but you'd be taxed at your personal tax threshold rate, and CGT or capital gains tax is tax exempt, which is also a function of your personal tax threshold. So really it's a great initiative from National Treasury to try and encourage saving, to try and encourage South Africans to save as much as possible. So really what it means is once you're inside of this tax wrap environment, everything is tax-free, which is really unprecedented in our markets. So what are the rules to this tax-free saving account? Every natural person can open a tax-free savings account, which means you can open an account in your personal name for your wife, for your children. As long as you're a South African resident, you can hold a tax-free savings account. You cannot, the one sort of limitation is you cannot transfer existing investments into a tax-free savings account. So if you have a unit trust with Coronation or whoever, and you want to transfer it onto your EasyEquities platform, if that saving was not within a tax-free savings account with that provider, you can't transfer that. It has to be fresh cash or between two tax-free savings accounts. So it needs to be recent. So 2015 was the first. We're just about to finish our second full year of tax-free savings accounts, which means if you were on the ball, you would have already had 60K saved in the tax-free environment. And really, other than that, it's pretty simple. You can invest lump sums. You can invest monthly debit orders. You're just capped at a maximum of 30,000 Rand per year. But what's really important is to try and have a long-term view on the tax-free savings account, because withdrawals from your tax-free saving are permitted, and you can withdraw as often and as much as you like, but they cannot be reinvested. So just to give you a little worked example of how that would work, if we looked at last year, our Feb 2017 tax year, if you contributed 30,000 Rand up until July of last year, and then you suddenly needed some cash for whatever event, you needed to pay for school fees, or you want to buy a mountain bike, and you withdrew 15,000 Rand, that means that you cannot then recontribute that 15,000 Rand for that tax year. So it's very important to have a longer term view with this, because once you've made that contribution, that's it for the year. You can only make up to 30K contributions, and that completely ignores any withdrawals. So you cannot recontribute to withdraw. So it's very important, and where we think a lot of clients have been misinformed and maybe misled is that tax-free savings accounts should not be for a one-year savings plan. It should be for a longer-term saving plan, really to take advantage of the tax efficiency. So when you are contributing to a tax-free savings account, what's important, if you're considering your entire savings situation, is just to understand a couple other exemptions that exist for individuals. So there is an interest exemption of 23,800 Rand for under 65 and 34,500 Rand for over 65, which means if you do need cash in the next year, you've got that exemption to work off, which effectively means any saving with interest less than that is tax-free. So you don't need to use your tax-free savings account allowance to get tax-free. Also, there's a capital gains exemption of 40,000 Rand. So a lot of guys didn't know that those exemptions existed and were investing into tax-free savings accounts and then withdrawing, and then of course they lost the ability to recontribute for the 30,000 Rand annually. So really it should be a longish term investment opportunity. So why tax-free? Why was this included? It's really an opportunity for investors to save or to invest in more efficient ways. It's kind of government's way of saying, let us try and encourage saving, and let's try and encourage a savings culture within South Africa, and allow people to save for long-term goals. And then it gives us the ability to create some kind of financial future security without the hindrance of tax. And of course, tax-free, basically no one likes paying tax, so why not take advantage of the allowance that government has afforded us? Really a no-brainer if you're saving for the long term. So once you've decided, yes, you want to save and you want to save in this tax-free environment, what kind of products can you invest in or save in? And really the criteria are very simple. The products must be simple, they must be transparent, and they must be suitable. What that means is there must be it must be an easy to understand product. I'll go through some of the product lists just now. In other words, not a highly complex structured product or something with gearing or and so on and so forth. They have to be simple vanilla products. Transparency, it must be easy to understand. There are problems with performance fees, which is great for the customer. If there's not transparency around fees and disclosures, then they generally don't qualify. And the suitability, there's a range of products, and you as an investor will need to either chat to your advisor or to try and establish what is a suitable product for your particular goal. So what you can kind of expect to see in the tax-free environment, and I'm sure you hear it on the radio, etc., is the one is interest-bearing accounts. Quite simply, these are either fixed-term deposits or cash on demand, and those are generally provided by the banks. They're quite simply money market funds, or where you'll get a fixed or floating rate interest. The other are exchange-traded funds, and importantly, only exchange-traded funds which are collective investment schemes. All of the Coreshares ETFs are collective investment schemes. What you'll notice on the JSE, there are a few ETFs that are not collective investment schemes, but you basically can say that all of the commodity ETFs are not collective investment schemes. So the gold ETFs, palladium, platinum, etc., you can pretty much exclude those out of your tax-free savings environment, and everything else qualifies. Also, unit trusts, which asset managers have, are allowed or are eligible products for tax-free savings accounts. These are generally provided by asset managers, so asset managers and stockbrokers. EasyEquities would be a classic example of a stockbroker. Coreshares would be the asset manager, or EasyEquities' sister company, Emperor Asset Management, would be an asset manager in this instance. So those are the kind of companies you can expect to see savings or long-term savings products from, and then various insurance products which have come out. These are all issued by your insurer. So basically what you can see is that for a product to be tax-free savings account compliant, they need to be issued by a regulated company, so your banks, asset managers, stockbrokers, insurers, and basically they need to be consumer friendly, so easy to understand, and they need to have a specific goal in mind or a specific investment criteria. And really what's great about the tax-free savings accounts environment is that you can see from interest-bearing accounts through to various asset management and insurance products, there's a wide range of products you can invest in through these accounts. One kind of technical question that may come out is you see there are different providers of tax-free savings accounts. And Waylon can correct me, but there is allowance for intra-tax-free savings accounts transfers to happen between providers. It hasn't been completely solidified in terms of the legislation, but certainly in future, if you, let's say, for example, had a tax-free savings account with your bank, an interest-bearing deposit, and you wanted to move that into an EasyEquities tax-free savings account and invest in ETFs or whatever, that is something that's going to be possible in the future. And I think the last National Treasury note came out about midway through last year where they were working out exactly how that was going to work. So that is one thing where there's a little bit more flexibility coming in for you as investors. So, I mean, that's tax-free savings accounts. As I say, really simple investment vehicles. If we just consider that it's an opportunity to save more efficiently, as long as you have the right mindset and you're looking at more of a longer kind of term outlook. The next part of this presentation we're going to be chatting about is really just ETFs 101 within the context of tax-free savings account. So as I mentioned, all exchange traded funds that are issued by Coreshares, so all Coreshares products you will see are tax-free savings account compliant. In other words, they are collective investment schemes. So what is an exchange traded fund and why does it qualify for tax-free savings account? So first of all, they're issued by an asset manager. Coreshares is the asset manager. Secondly, they are collective investment schemes, which is effectively a unit trust as we know it in the common terms, and they are regulated by the FSB and the JSE. So highly regulated vehicles, and they qualify first of all on those terms, but they also qualify because it's a fund structure. So for the client, it's a diverse holding of a number of shares. So ETF stands for Exchange Traded Fund. They can be bought and sold on the exchange. So classic example would be through the EasyEquities platform. You'll have a look through and you'll see which products are qualified for tax-free, and you'll see all the ETFs, which you'll buy through your brokerage account effectively on EasyEquities. They obviously traded, so intraday trading, online stockbrokers, etc. Can buy them, and it's a fund. So what that basically means is you're buying one unit or one share, and you're getting access to multiple shares on the underlying. So if we just think of a very simple example, like the S&P 500, Coreshares as a S&P 500 ETF, you buy the one Coreshares, which is S&P 500 ETF, which is CSP 500 share code, and you get access to those 500 underlying shares. So all of those big names in the US that we'll be familiar with, Apple, Microsoft, McDonald's, Facebook, etc. By buying one share, you get the efficient exposure to a whole basket of shares. So, and really that's one of the beauties of ETFs and why they've become so popular globally. If you have a look at the global trends, ETFs now have over $3.3 trillion invested globally, and you can see the growth is really quite phenomenal over the last 10 years or so, and there are over 4,800 ETFs. Fortunately, on the JSE, we have a much more limited range of ETFs, which actually makes it slightly easier for investors. And really, there's been a lot of global endorsements of these products. They tend to be very consumer friendly. Guys like Warren Buffett has endorsed the passive investing philosophy, where he made a comment in his Berkshire Hathaway annual report back when he said that if he were to advise his trustees of his family money after he passed away, he would advise that 90% goes into S&P 500 tracker and 10% into cash. So, you know, a lot of these global thought leaders in investments are starting to endorse passive. So it's certainly a trend that's growing. And really, why passive and why ETFs more specifically for the case of tax-free savings? They're transparent. If you recall the requirements for eligible products, transparency was one. So you as an investor know exactly what shares you're holding in the underlying at any time. And what this is relative to is to an active portfolio where you may not know the underlying holding. Someone may have sold out or be sitting in cash. So there's full transparency, cost transparency, and holding transparency. So the headline cost is what you're going to pay, and that's as simple as it is. There's liquidity and flexibility in ETFs, which means that you as an investor can buy and sell ETFs intraday. There's pricing intraday. There's no limitations of how little or much you can buy. So very flexible from that perspective. And one of the key benefits is the diversification benefit. So if I just stick to that S&P 500 ETF example, when you buy one S&P 500 ETF on the JSE, you get immediate exposure to 500 underlying shares. Now, as an individual, to go and try and buy those 500 shares and hold it in a basket is near impossible. So you either need to be extremely wealthy and have a huge portfolio to invest, or you're going to really struggle. So settlement costs per share, trading costs per share, relative to buying one ETF and getting access to a whole basket of shares. So the diversification benefits are huge. And Coreshares really stands for that core satellite methodology, where you as a classic online stockbroker traditionally would just be buying shares. We say, hang on, why don't you hold an ETF as your core holding, which is invested into numerous shares. You're not taking stock-specific risk. And then you can have your sort of high conviction stock picks around that. So that's kind of our philosophy, and we think for investors it makes a lot of sense. It's smart investing. You're not sacrificing on returns, and you're getting broad diversification. The next point is they're highly regulated. As I said, they are regulated by the FSB and the JSE, and therefore they also qualify for tax-free savings accounts, and they're cost effective. So really, why that's so important is that costs erode returns over the long term. So the next graph I'm going to show you is a really simple graph, and it shows you 100,000 Rand lump sum investment over 30 years, and we've assumed a 14% per annum return. So that's the difference of 1% in costs. Now your average sort of active unit trust portfolio is probably somewhere between 1% and 1.5%. Whereas your average passive equity portfolio is probably going to be somewhere between 15, 20 basis points and 50, you call it 60 basis points. So on average, you're saving around 1% by investing passively. What that means over the long term is that the active managers have to outperform, and they have to outperform by more than 1%, which, as I'll show on the next slide, is extremely difficult to do so. So in real numbers, what that means is if you are underperforming by 1%, or your costs are contributing to 1% of underperformance every year over 30 years, it becomes a significant number on a return of like 14%. It becomes even more significant when your returns are more subdued. So if you can imagine 1% as a fraction of 14%, imagine returns over 30 years are 10% per annum. It suddenly becomes a more meaningful percentage of your annual return. So in this example, by saving 1% a year, you effectively have an extra R1 million at retirement to invest, which over 3.5 million Rand is a significant portion of money. And this is, a huge part of the benefits of passive and of the ETF routes. I mentioned, can you outperform or can you beat passive? This is a report that's generated by S&P Dow Jones, and it just looks at the professional active asset managers. So these are the guys with PhDs. These are the guys who are actuaries and CFAs and CAs, and this is their track record. So 86.3% of the active universe underperforms the top, the broad equity benchmark, so the passive benchmark over a 5-year period. And what's really interesting is that this number is pretty consistent throughout all time periods. Now, we're not saying that there will be no outperformance. What we are saying is that there's very little outperformance, and that the difficulty for you as an investor is to select the outperformance consistently and to select them in advance of their performance. So statistically, what you see is very similar numbers through all rolling periods, but what you also see is very little consistency across outperformance. In other words, there's not one asset manager who tends to outperform through all periods regardless of what the markets have done. So really, as an investor, it becomes a bit of a no-brainer to have a large portion of your assets invested into passive portfolios. And because they qualify for tax-free, and because we're positioning tax-free as a long-term savings vehicle, the savings on top of the tax efficiency of costs becomes significant. So really, that's it from us. As I mentioned, we haven't gone into too much detail on the tax, etc., but we're going to take some questions now. So please ask if you have any questions. So the first question we've got is, would you recommend investing a full lump sum of 30K once off, or investing a certain amount every month? Would it make a difference to the percentage of the return you see? It's a very difficult question to answer in terms of the difference in percentage returns. Obviously, there's a lot of timing risk involved with investing lump sums, which means that you may be on the good side of timing. So let's take an example of this future tax year coming. So starting 1 month, March 2017, if you chose on the 1st of March to contribute 30K to your tax-free savings, and the markets had a really good year, you would have been in the best possible position to probably invest that lump sum. However, if markets are volatile, or if they drop until June and then increase until March again, then your monthly contributions would have been better. So what a lot of advisors tend to recommend is a monthly contribution. And the reason for that is you just strip out a lot of that timing risk. So market-specific risk becomes less of an issue because you're effectively buying at 12 different time periods in the market, which means you get an average cost price over that year. So it really depends on your preference as an investor, but a monthly contribution is a very sensible way of investing. The next question is, can you make multiple payments into your account in the course of the year if you haven't stuck 30K in there in the first place? I think the question is saying, do you need to do a one-off 30K contribution, or can you do ad hoc contributions to your tax-free? You can invest that 30K how you like, as far as I understand. Waylon can correct me on the EasyEquities platform side, but you could have a monthly debit order. You could have a one-off lump sum. You could have multiple lump sums.
Yeah, so it works out to about 2,500 Rand per month. So even if you don't have the lump sum of 30,000 Rand, you can absolutely spread that 30,000 Rand over the period of the financial year.
Yeah, so it's really the flexibility is in your hands as the investor. Next question is the Coreshares DivTrax ETF tax-free savings. Yes, it is. Coreshares DivTrax ETF is a collective investment scheme and an ETF, so it absolutely qualifies for tax-free savings accounts. Where did the insurance products fit in? That's a good question, and I'm not an insurance expert, so I'm not going to go out on a limb. But I will say that insurers do issue multiple products. So insurers do issue products that look a lot like fixed income deposits. And they do issue products that look a lot like asset management kind of products. So without claiming I'm an expert in the area, there could be multiple insurance company issued products that would fit within a tax-free savings environment. But as I say, I'm not an expert on the insurance side of it. I think I'm going to hand this one over to Waylon.
Got a question here. Can you expand on the basket options on EasyEquities? So because EasyEquities is very much for the beginner investor, our asset managers under Emperor Asset Management has put together these baskets of ETFs that you can invest in on a tax-free savings option. Now, there's a couple of baskets there, and you can do the risk lies on EasyEquities. So if you are more, so we've got different baskets. You've got more aggressive baskets, conservative, growth and income. So instead of trying to figure out which ETFs are the best to purchase, you can just buy a bunch of ETFs that we've already put together in these baskets with different aggressiveness styles. So it's basically just making it easier on the new investor that doesn't know, basically what to look at or can decide what they want to invest in as a single ETF.
Great, thanks. We've got a couple more questions. One question says, okay, we'll email this whole webinar is being recorded, and EasyEquities guys are going to post it on their YouTube channel, so you'll have the slides and the audio. I'll also email the slides to Waylon and the EasyEquities team so they can distribute it if you'd like. One question, why should I invest in Coreshares tax-free savings versus other institutions? Quite simply because we're the best in the market. It's as easy as that. Just kidding. Look, Coreshares competes with a lot of tax-free savings products. You as an investor need to understand what you are looking for in your investment. If we have a product that meets your requirements, then great. If there's a competing product with that, then please drop us an email at info@Coreshares and we can answer any questions you have. But no need to specifically use Coreshares. We'd obviously love it if you did. But yeah, you can look at any institution. Okay. Which is better in your view, tax-free savings account on an investment with a low risk and low return, or tax-free saving or high risk and possibly a high return? Again, that's quite an advice-specific question. So I'm going to lean away from answering. You need to understand what your objectives were with your tax-free savings account. So if you have a very long-term mindset, and I'm talking about the tax-free savings account, your lifetime contributions is over 17 years odd. So that kind of mindset, you should certainly, if you're going to invest and not withdraw for 17 years, then yes, I think being invested in a high risk with a high return profile is worthwhile. If your time horizon drops significantly lower to 3 years or so, then you need to understand what your goals are, your objectives, and you need to invest appropriately. So there's no right or wrong answer in terms of going from, let's say, fixed deposit, which is right on the like almost risk-free side of the spectrum without ignoring the creditor risk, all the way to like a high equity portfolio or equity-only portfolio, but that depends on your objectives. So I think you really need to understand that. That looks like all the questions. So thank you to everyone for tuning in. As I mentioned, if you've got any questions, please drop the EasyEquities guys an email or email Coreshares at info@Coreshares. We can answer. We've got one more question that came up last minute. Is there a difference between investing tax-free through EasyEquities or going through a holding company such as PSG? There really, in terms of the tax shield that's provided by National Treasury, there is no difference. What you do have to look out for is costs. EasyEquities prides themselves as a low-cost access into tax-free savings. So again, you have to compare product by product. But in terms of the actual tax savings and the tax shield that you get for your 30K annually, there is no difference between providers. You really have to analyze them on a case-by-case scenario. So yeah, thanks again. Thanks to Waylon and the team from EasyEquities for hosting us today. If you've got any questions, drop them or us an email and we'll get back to you as soon as possible. Thanks for your time and have a great day forward.